Thank you, everyone. Okay, well, I just want to give you a little bit of background. I am something of a financial crisis junkie. You know, even before it blew up in all of its glory, I was collecting books and such on the crisis, its prediction, its unfolding, and everything related to it. In the Casualty Actuarial Society, we have a research committee. It's called the Data Management and Technology Committee, and they run a call paper program every 2 years. And they look for papers with a focus on data, but technology also. And I thought I could combine two interests here because we actuaries have standards of practice with respect to data quality that have to do with things like accuracy, completeness, appropriate for the analysis at hand. And it occurred to me that of what I know, just as a member of the public, about the financial crisis, a lot of the principles involved in it violated the standards all over the place. So I thought I could write a paper that focused on data and its role, data and maybe the lack thereof in many instances, and the role it played in the financial crisis. So I have two manifestations of the crisis I will be talking about. The first one is the Madoff Ponzi scheme, and the second is the mortgage crisis. And much of what I will be showing you is just relatively simple exploratory data analysis. Most of the data in the paper was obtained from public sources on the internet. And there will be some data mining red meat that I will be throwing out so that we could satisfy those of us. Because I did want to show that you could use this stuff for modeling, and it possibly could have prevented some of what actually occurred. Okay, so the Madoff Ponzi scheme. Should his fake data have been detected and the fraud prevented, at least prevented earlier? I was, by the way, going to play a podcast for you of somebody interviewing Madoff. He was a little harsh on the Securities and Exchange Commission, and he claims that it took him about 5 minutes to determine that the data was fake and 2 hours to prove it. Okay, now doing a bit of hunting on the internet, I found some data from one of the Madoff funds, and its monthly returns on the fund from 1991 through the fall of 2008. I downloaded it early this year, roughly in January. Most of what I am going to be showing to you is what Markopoulos, who was the whistleblower who went to the SEC claiming that this was a fraud, most of it is what he described in his testimony to Congress. Okay, so here I'm just showing you two asset returns that are sort of pretty similar to each other. One is the S&P 500 return, and the other is the S&P 100. The idea is these two assets are close but not exactly the same, but their histograms look pretty similar. Now compare that to this. Okay, the first box is the return on the Madoff funds. The bottom box is the return on the S&P 100. And the reason why that's relevant is because Madoff claimed that he was investing in the S&P 100. Now, he was doing something called a split strike strategy, which I can't exactly tell you what it is, but it involves options to prevent some of the downside risk. But what you would expect is, even with some of the derivative aspects to it, you would expect the returns on asset classes that are somewhat similar to look a lot more similar than these two histograms look. And one of the things, of course, you see is that the returns on the Madoff fund are very, very tight. And the returns on the S&P 100 are, compared to it, are very dispersed and much heavier tailed. Okay, then you just run some descriptive statistics. And what you see when you do that, and here the ones I'm going to focus on in particular are the mean and standard deviation. So we look at the Madoff compared to everything else. Number one, it has the highest mean return. And number two, the lowest standard deviation. And by a lot, it has the lowest standard deviation. And by the way, this combination over here, high return, low risk, that's what in economics they call a free lunch. And it basically, unless you're cheating, in real life it doesn't happen. You know, you see something similar in that, you know, the Madoff fund has the lowest kurtosis, and as you know, the real assets have a high fourth moment because they have a heavy tail. Okay, and another thing that Markopoulos described was he just took a look at how often the returns on the Madoff data went negative. So you can see Madoff, 7% of the months had a negative return compared to not just stock funds, but compared to, I threw in here, just because it should have lower volatility, a Vanguard balanced fund and a Vanguard long-term bond fund, each of which you would expect to have lower volatility, and in fact they do compared to like the S&P 100, but although that, you know, actually they're fairly volatile also, but the Madoff is way down there. Well, I mean, it's a real outlier in terms of the negative returns compared to all the other asset classes. Again, it's just showing you that it's too good to be true. What you're seeing is too good to be true. And also just taking a look at the minimums and maximums. Again, the Madoff fund minimum is, you know, just way below, like by an order of magnitude. It's way below all the other asset classes that I used for comparison. Okay, now there's something I'm going to, you know, that is often used to by people doing forensic accounting to uncover data that's been made up, essentially. It's called Benford's Law. And it is a distribution, and, you know, this table shows the distribution. It's the distribution of the first digit of a financial amount that you would find in, you know, in accounting data. And the main point here is that the digit that occurs most frequently is 1. The second most common digit to occur is 2, and, you know, it keeps on going down. This often is successful in uncovering fraud because the fraudsters usually think that the digits are uniformly distributed, and they're not. Now, this is just showing you on the Madoff return, the red line in the middle is the theoretical Benford's Law distribution. And you can see that the S&P 100 is pretty similar. It drops down a little below it. What I found unusual was that the Madoff fund seemed to have an excess of returns that start with a 1. On the other hand, I don't consider this particular comparison, though, to be a real slam dunk. I would say that this is not making the case from my perspective, even though it would fail a chi-square statistic test that it's comparing the actual to the theoretical distribution. But a lot of that's a test that's easy to fail. So, but what I would say is it might be more likely to be successful if we could actually find the original money transactions as opposed to the return data. All I was able to download was just a series of monthly returns. The original transactions underlying this might actually fail the test. And I would say what inspired me to look at this was I found on a website somebody who claimed that he applied Benford's Law to some Markopoulos data, and it failed the test. But the website was a little lacking in specifics about exactly what data the test